How to survive and even thrive in this unfolding asset crash. Now, I have personally experienced a few asset bubble crashes, and I've learned a few things. And I did very well after the last crash of 2008, 9, and 10. And I think with a couple of crucial tips, you can do well when, not if, we complete this next asset crash. Hi, I'm Douglas Lucky Larson on the Retire Early and Often channel, and here we like to discuss an early retirement lifestyle that's not just about money, but about doing the other, even more important things like building stronger relationships, expanding your knowledge and skill base, and pursuing a real purpose bigger than just simply focusing on a monetary nest egg. However, a huge part of a retirement lifestyle is your finances, which are under threat right now. It's no joke. So, what to do as assets crash? First, ignore the constant media drama that the sky is falling every minute. Everyone knows that sensational headlines catch eyeballs, and that's why so many headlines and thumbnails, even mine, have fire and explosions and words like recession and crash. It's not likely that the United States will see a Great Depression or even another 2008-style recession, but headlines insist that we're going back to the Dark Ages, or we're going to be without food and energy and we'll live like cavemen. Probably not. Let's read a couple of headlines here just to get a picture. Recession is here and will last for a while, former White House economist says. How about CNBC? Ugly inflation numbers make a recession more likely in 2022. Bloomberg, we are already in a recession. CNN, recession is likely coming. How bad will it be? New York Times, chance of a recession? Here's what economists are saying. USA Today, recession is coming. Has inflation peaked? How to tell? On and on. Young Americans are in for a rude awakening with the coming recession. How can you prepare for a coming recession? Anyway, it goes on and on and on. You've seen the headlines, you know. Let's go to the next. Here's some clickbait headline thumbnails, and you've seen these as well. This guy here, yeah, I call him Clickbait Nick. He gets a lot of views, but guess why? Biggest crash ever, $25 trillion. For assets to make you money? Yeah, in the next crash, yeah, that one might actually be worthwhile. The end. The complete collapse of the U.S. housing market. There you go. It's the end. 5 things to get now before the dollar crashes. How about Jeremy Grantham? The crash will be worse than in 2000. On and on it goes. Housing market crash. The collapse has begun. Ray Dalio. The worst case scenario. Really? Worst case scenario? Michael Burry. Everyone will be terrified in 21 days. Wow, that sounds pretty bad. Now, I actually do think that it's pretty smart to be personally prepared with some extra food and water and security preparations. But living with constant anxiety of impending economic disaster and even a zombie apocalypse, well, it's not going to serve you well. There are some government safety nets that are in place that most Western countries have that simply weren't around, say, 100 years ago, 80 years ago, during the Great Depression of the 1930s and early 40s. So our modern worst-case scenario probably doesn't include starvation. Now, watching some news sources, you will find that some countries face real threats, like Sri Lanka, Turkey, Egypt, Afghanistan, Pakistan, and even Argentina and Peru. These countries and several others are already facing food riots and energy blackouts and monetary debasement. And it actually might reach an apocalyptic level in, the next year or so. But Western countries, especially in the US and Canada, will likely be spared the worst of it, at least this time around. Now, ignoring the inflammatory headlines is crucial because too much anxiety can simply cause paralysis in a time when you need to be thinking clearly and taking action, not freeze like a deer in the headlights. Just waiting in the middle of the road to be hit by that next oncoming truck. No. Now you gotta love this meme over here. This one's made the rounds on Twitter and Facebook and Instagram. It says, when the insurance company wants a diagram of the accident, and then it's got this hilarious hand-drawn cartoon of a very surprised deer just before the guy in the car hits him. I love that. Second, you got to realize that in every crash, not everything crashes. That's right. Now, for example, when everyone got locked in their homes in the beginning of 2020 with the whole COVID craziness, well, there were companies like Netflix and Zoom and Peloton that went crazy, along with Amazon orders. My friends with Airbnb rentals thought their world was about to end. A tenant of mine who was driving for Uber at the time went without pay for several months. Small businesses like hair salons or local gyms were just out of luck until PPP loans and government stimmy checks came to the rescue, and it helped keep them afloat. It was a crash for some businesses and a huge boom for others. In 2008 and 9, in the real estate crash, it was a bad time to be a real estate agent or a mortgage broker or in construction, and several of my properties lost digits on the sticker price. But guess what? Rents kept coming in, and self-storage facilities became busier than ever. It's not always easy to know what's going to boom when something really breaks in the economy, but history can always teach us something if you're willing to look for the clues. Later in this video, I'm going to give you some tips for what I think is coming next. But first, you have to hit the like button. The third thing you can do when assets crash is remember that slow and steady usually does win the race. If you're talking about a 10 or 20 year or more race. You gotta love this cartoon of the tortoise and the hare, but the rabbit is actually the Energizer bunny who looks dead laying over on his side, and the tortoise has stolen his batteries. Many house flippers, always looking for that fast cash, got just absolutely burned in 2007 and 8 and 9 because home prices dropped so fast and so broadly across the U.S. There are home flippers right now that are about to lose their shorts because they bought 3 or 5 or 20 properties about 3 to 5 months ago. And these flips they're doing are not selling for the prices that flippers need. Again, back in 2008 and 9, when price tags for homes were dropping and foreclosures were common, people still had to live somewhere. And lots of landlords, including me, just kept collecting mailbox money. That's how the slow and boring turtle becomes successful. The same will likely be true moving forward if buyers continue to be priced out of the housing market because of higher interest rates, and also some people will have to leave their homes because of job layoffs. However, rental income, especially in the lower tier of each market, will remain pretty steady or even get stronger. Now, with stocks and other market trading, many investors who wanted to be the bunny rabbit, they've now been burned in the tech sector or crypto space, and they're suddenly rediscovering the wisdom of examining stocks and companies based on actual earnings and profitability and dividend payouts. What a concept. That fundamentals actually matter? Who knew? Great companies with great market share, they're going to help a lot of people keep and grow their wealth, even in tough times. Companies like Costco and Walmart and Dollar Tree, they might have an inventory glut right now and not be posting the best of earnings, but hey, I tell you what, they did very well in the last big recession, while Neiman Marcus and Lord & Taylor were struggling. It turns out that you can't eat a Rolex or a camel hair blazer. Who knew? One more thing to do to weather this crash is that you must have some dry powder, as in real cash or liquid credit that you can use when you see unbelievable bargains. In the crash after 2007 in real estate and stocks, well, lots of people were hurting, including me. But anybody with some cash could buy assets at up to 90% off. That could have been cars and trucks, or a Harley Davidson motorcycle, or real estate, or stocks. I lost half my net worth in 2008 and 9, but I kept my credit intact. I did not default on a single home loan. I also had several $100,000 in real cash money sitting in the bank. Actually, two banks to make sure it was protected, FDIC. But I started buying land and foreclosed homes at literally 60 to 85% off or more from their highest valuations in late 2006. On the next page, we'll see a couple quick examples. There were vacant lots and cheap houses galore, but it was hard to get financing, so you needed to have cash money. This property on the upper right over here, this is something I picked up in the Salt Lake City area for $95,000. Yep, that's right. It had been valued at almost $300,000 just a couple years earlier. This property here I also bought in 2010. This was in North County, San Diego. And this one I paid $195K at a foreclosure auction. And guess what? It had been valued at over $500,000 just a couple years earlier. This is where I really made a lot of money, buying literally dozens of vacant lots. Now, these aren't the exact lots that I bought. This is just an example. You can take a look at what builders are doing right now, and you can see the progress of some of the neighborhoods. So if you look over in this area here, these homes are finished. They may even be occupied. You look over here, and this guy's got a driveway, but this guy does not. That is an unfinished house. This one here has no roofing on, and this one here is just a foundation and a basement. Same with this one here. What happened in 2008, 9, 10, there were entire neighborhoods. Check out this over here, where just the foundations maybe had been poured, and you had all of these lots over here that nothing had been begun. And the builders had overextended themselves. Maybe they had built out the clubhouse or something, and they were about to put in a pool. But guess what? They did not have the cash or the ability to get loans to go ahead and fund this house and this house and this house. And so you could go in and literally buy 3 or 5 or 10 lots at a time for pennies on the dollar. I literally paid $15,000 and $17,000 and $20,000 for some lots that had been going for $90,000 to $120,000 just a couple years earlier. Those kind of bargains are real. Now, in a situation like that, you can't go right back out and sell them for what they had been selling for, but we went out and sold them 1 or maybe 2 at a time to builders that needed lots that had real buyers, not straw buyers, but real buyers that were ready to go ahead and build in 2011 and 12 and 13. So we did make some money, usually double or triple the amount that we pay for the lots. Now in stocks, you could have purchased Amazon and Google in 2009 at less than 10% of what they're going for right now. Maybe 60 or 70% off of what they had been going for just a couple years earlier. Now, if you had invested $100,000 back then, you would still be sitting on $1.5 million right now, even after the last 8 or 9 months of stock price declines. In 2015, you could have bought Bitcoin after one of its crashes at under $300 per coin. Even if you didn't sell at the last peak of $69,000 in last October, November, and let's say you liquidated at $30,000. Well, $100,000 investment in 2015 would have become $10 million. Holy cow. One more thing to remember before I talk about what I think is really coming next is that the smart, old, rich guys that I know tend to approach investing as a long-term business, a marathon, not a sprint. You guys know Usain Bolt from Jamaica. He is the fastest man on earth in the 100-meter. But I know a couple of 50-year-old guys, literally in my own city, that could beat Usain Bolt in a marathon because they have trained to run at a measured but deliberate and steady pace over a long period of time. Running a long-term profitable business strategy is a lot like a marathon. I love investing in real estate, like a business, not like a day trader. I have done some flipping, but only as a strategy to buy more long-term holds long-term rentals. Many of the properties that I've sold in the last couple of years were homes that I had already owned for 2 to 4 years, and they just weren't my favorite assets. So I decided that in that hot, trendy market that I would trade them in by 1031 exchange, tax deferred, and I would put that money into other assets that I like better and that bring in a better cash flow. Again, think long-term business. It's a marathon, not a sprint. Now, for my predictions on what we should see for the problems and opportunities for the next year or two, let me first get out my crystal ball. Or maybe the magic 8 ball? No, I don't have one of those. Actually, I listen to some very smart people in macroeconomics, and you'll see some of these guys right here. Mark Moss, Chris Martinson, George Gammon, Ken McElroy. Here's Robert Kiyosaki, Joseph Wang, Doug Casey, Jeff Snyder, Brent Johnson. These guys are brilliant. Many others. I've been to their conferences, and I've met them in person. So with their influence, along with my own research, I think that in some overbuilt and overhyped real estate markets like Phoenix and Boise and Las Vegas, real estate price drops will continue. And in another 6 months or a year, we might see some incredible bargains. I follow Gareth Soloway on crypto. I think his price target of Bitcoin around $12,000 or below within the next 6 months or 1 year could be a buying opportunity of a lifetime. He's done the research. I follow him. I've heard a lot of other people. If you follow Michael Saylor, you probably would have lost a lot of money. But Gareth Soloway has nailed it. I think Kenny McElroy and Jason Hartman have nailed the real estate space with continued recommendations for solid cash flowing assets in single and multifamily homes that will just continue to put money into your pocket every month, regardless of what the price tag says. A lot of people want to talk about gold and silver and uranium and other commodities, and I like those speculative plays, but my strategy has always been to put the bulk of my money and energy to work in slow and steady real estate, passive income. One fairly easy way to start this, if you're really a beginner, is where I started in real estate investing, with house hacking. I was living on Maui in the early 2000s, and I couldn't really afford those house prices. So I bought a house and rented out the rooms in order to pay the crazy mortgage, and it worked out great. On this slide, you'll see 2 of the 5 properties I owned on Maui in the early 2000s. This one on the upper left up here, this was a house I bought, and it functioned as a duplex. This was one side that I rented out, and this was the side that I lived in. Worked out great. This here is a house. This one I chopped it up even further. This one worked like a functional 4-plex. I kid you not, and I lived almost mortgage-free. I owned the home, and everybody else was paying my mortgage. And I got to enjoy life. I had a day job at the time, but any hour off on Maui is an hour on vacation. To summarize, I don't give advice, but I hope that some of this infotainment has been useful to you. Let's talk about some of these things. Can you ignore the clickbait noise? Block out the drama. Can you prepare for the future, not panic, but stay informed and also take action? Can you find the positive as you realize that in all crashes, not everything actually crashes? Can you remember that slow and steady wins the race? Day traders and gamblers and house flippers often win for a while, and then eventually one double or nothing roll of the dice takes them out. Don't do that. Can you have some extra cash and credit ready for those bargain buying opportunities when they come? Now, I'm not saying that you and I will be perfect at timing the next bottom. I believe in time in the market is much better than trying to time the market. You've heard that phrase before. I didn't make it up. But that's my strategy. But whether it's real estate or Bitcoin or commodities, you will still recognize some extra awesome bargains probably in the next year or so, and it'll be time to jump. Hey, will you please give us a like and subscribe and share? And please join us in another few days for another episode of Retire Early and Often. Hope to see you then.